Hi guys, good afternoon. So today we move into the second half of level one where we will talk about derivatives. Okay. So the way we will go through today's topic is we will first talk about what is derivatives, why, where, etc. Okay. Then we will talk about your first derivative contract, which we call as a forward contract. And once we get through that, we will then talk about a futures contract. Okay. Now, let me start off, or let me ask you guys a question. What does the word derive mean? I don't want a financial definition, but a generic definition of what does the word derive mean? Can anyone tell me?
Came out from something.
Okay, it's
Came out from something which
okay. It's come out of
takes its
something.
value from some other thing.
Okay, maybe takes its value, or it's maybe an offshot of something else, right? Uh, so, and if, when you look at it, right, when you look at the word derive, you can actually derive a lot of, well, you can create a lot of examples out of it, right? So, for example, if we talk about a gold bar, out of a gold bar you can make so many things. You can derive out of that like a chain, or ring, etc., etc. Or there's a lot of other strange examples, like for example, even we are a derivative of our parents, right? So that's the idea, is that it's come out of something. Okay. Now, when we talk about derivatives from a financial instrument perspective, okay, uh, how we define a derivative is very important. And one thing that I want you guys to be clear with derivatives, especially, is that um, you have to, I mean, you should not mug it up, obviously, but you have to use the right terminology when you're talking about derivatives, okay? Because if you don't use the right terminology, then it's basically wrong, okay? Now, let's get to the financial markets aspect, or the financial instrument. Now, if you guys can tell me, what is the definition of a derivative?
Derivative is something which derives its value from the underlying securities or assets.
Okay, all right, that is partially correct. What are you missing, Piyush? So your answer is not wrong, but there's a key thing that you're missing.
Fine period
Sorry?
of contract, underlying contract under a derivative is taken uh, uh, at a predefined period, basically the
Okay.
time frame.
Okay, time frame. Okay. All right. Now the key word when we talk about derivatives, and this is the thing that you have to use, is when we talk about derivatives, it is a contract. Okay, it is a contract. Now, when we talk about, so that's the first key thing, right? It's a contract. Now, what does a contract mean? Can anyone tell me?
Binding between two people or companies.
Binding.
Agreement.
Yeah. So
It's an agreement between two parties.
yeah. So when talk about a contract, right, it is an agreement. Okay. So let's look at the definition here. So derivatives is a contract. Now, what is a contract? It's an agreement. Okay. Which derives. Now, what is the word derives? And we just talked about that. Takes its value. Now, what is the value that we're talking about in this instance? Is its price. Okay. And that price is coming from an underlying asset, which is a financial instrument, such as an equity, a fixed income, currencies. It can be also other derivatives and commodities, etc. Okay, so the derivative market is extremely large, and it's also extremely risky. Okay, it's extremely volatile, and those who don't understand derivatives really well, right, they end up losing a lot of money when they play around with derivatives. Okay, but the key words that you guys have to know: it's a contract which derives, so the word derive, and its value from an underlying asset. This is how we define what is derivatives. Now, if, for example, right, if you don't use the word contract, right? And you say derivative derives its value from an underlying asset, that doesn't make any sense to anyone, right? And especially when you go to an interview, the immediate cross question is, what do you mean by that, right? So I'm not again telling you guys to mug up, but it is important that you guys what do you call it, use the right terminology for derivatives. Is this clear with anyone? Yeah. So it's a contract which derives its value from an underlying asset. Okay, so quickly write this down, the definition, and then we'll move on to the next thing. And as always, let me know once you're done. Everyone done? See, there's 31 people here, and there's 1, 2, 3, 4, 5, 6, 7. Okay, now, okay. All right. So why I keep doing this, right, is in my weekday batch, the entire batch just, like logs in, but they just put me on, you know, uh, they just have their laptop open and they go out and they do their work, and they do all sorts of random things. And then when I ask them questions, there's nobody there. Then they come back saying, "Oh, I had a network issue. I couldn't hear you." Yeah, yeah, sure, sure. Yeah. So that's why it's important to communicate. Okay. Now that we've understood what is derivatives, now let's understand why derivatives is used. Okay. Now these are specific words, and please don't interchange them or confuse yourself with them. Okay. So when we talk about why is derivatives used, there are three main reasons. Okay. So the first one is what we call as speculation. Okay, now what do we mean by speculation is in the hope of profit, but with the risk of loss. And 95% of the derivative market are all speculators. Okay, now let me ask you guys a question. Uh, how many of you do speculation? Not necessarily in terms of the financial
Everyone,
markets.
everyone,
Sorry,
everyone, sir,
everyone?
everyone.
Okay. So, Piyush, can you give me an example? Not in terms of financial markets, in terms
Yeah,
of
sir, we
daily.
can speculate.
Uh,
Sir, we are speculating that we will get a good job in a decent company.
okay, very
So
good.
that is our speculation. That's why we have joined this course.
Very good. Yeah.
But
Yep.
sir, there is a guarantee here, so it won't come as a speculation. There is a
Sorry.
job guarantee in this.
Yeah,
There's a
yeah.
job
Who
guarantee.
will who will who will win this year's IPL?
So that could be a
It's like that
speculation.
game.
Yeah. So,
Yeah,
but largely,
yeah.
right? So this is something maybe you guys are not aware of, or maybe you've never seen it from yourself. But maybe tomorrow morning when you do. So let me tell you guys this. So when you guys get up in the morning and you go outside your house, okay, where do you generally see? Do you look to the ground? Do you look straight ahead
What
into your neighbor's
what
house,
will be the
or do you
weather
look up?
today?
One second, one second. So, or do
What
you
will be
look
the
up?
weather?
Where do you what do you do?
Whether it will rain today or not.
Yeah, Fine,
Up,
but my
up. We
question
look up.
is, where do you look?
Up.
Look. No, actually, I'm saying once you step out of the house, do you look at the ground? Do you look into your neighbor's house? Or do you look up?
Up.
Okay, now
We
why
look
do
up.
you look up? Why do you look up?
We want to get hold of today's day. What will happen? How is the weather? How is the sky looking? All that.
Yeah. See, when we look at this thing, right? The sky as soon as we get up in the morning, it's actually comes from a evolutionary point of view when we were all like cavemen and all of that, and you didn't have cities and we were at the mercy of nature. So if we had to millions of years ago, if we had to go out and hunt and gather food and all of that and resources, the biggest at that time the biggest danger was the weather, right? So we used to look at the sky to see what would the weather be like. Okay, and that's basically, even now when you look up, right, you're unconsciously thinking about, hey, what will the weather be? Okay, now for example, like I'm in Bangalore, and Bangalore has really weird weather patterns. Okay, I'm pretty sure it could be the same in Delhi and the rest of India, where it can be very bright in the day. I mean, there's no cloud at all in the sky, and by afternoon, a huge storm comes in and it's raining, right? Or it could be that there's just one cloud in the sky, but it'll be freezing cold. So there's a lot of different things that happen uh, in your mind when you look at the sky. And basically, what are you doing is that you're trying to see what is going to happen today in terms of the weather. So that is the idea of speculation. Now, when we translate that word speculation into the financial markets, what you're essentially doing is that you're expecting to make money, right? You're expecting to make profits. Now, nobody expects to make losses, obviously, right? So that's why we use the term hope. You're hoping to make money, but there's going to be a risk associated with making that money, and you're okay to take that risk. Now, what will that risk be? Maybe you will lose your capital or lose your money. So that is why we use the term for speculation in the hope of profit, but with a risk of loss. Okay, is this idea clear with everyone when we talk about speculation? Okay, so for example, if I say, Reliance Industries share price is going to start going down, right? That's a speculation. If I think, what else? Maybe TVS Motors share price is going to go up. Yeah, that's a speculation. Or if I think ITC share price is going to go down, that's a speculation. So based on my speculation, I will either make a profit or a loss. Okay. All right. Now, the second term is what we call as hedging. Okay. Now, let's be clear here. When we talk about hedging, what we mean by this is that you want to protect yourself against price fluctuations. Okay. Now, what does that mean? If you bought let's say, you bought, let's say, 100 shares of Infosys, right? Now, if you bought 100 shares of Infosys, what are you worried about? Are you worried about the price going up or worried about the price going down?
Price going down.
Yeah, exactly right. Now, this is the interesting thing with derivatives, is that you can enter into a derivative contract that will protect you from the price going down. So this is what we mean by hedging. Now, let me draw another distinction. So somebody who's a hedger, okay, they will own the underlying asset, okay? But a speculator may not own the underlying asset. Okay, so that's the cool thing about the derivative markets, right? Is that you don't have to own the underlying asset. You can just bet on the price movement. Okay, but in hedging, you have to, I mean, basically, if you own the underlying asset, you're a hedger. Okay, is this part clear with everyone? Okay, so speculation, you're expecting based on your research something to go up or down, and based on that, you're going to make money. But if the price goes down, you're okay to take that loss. Okay, now when we talk about hedging, you own the asset and you want to protect it against price fluctuations. Okay, so speculation and hedging. Now the third one is arbitrage. Okay, now the sense of arbitrage is actually happens in real life as well, right? You buy a particular product in one market. Now let's say you go to a particular area, or let's say you go to a particular area where electronics are very cheap and you're a retailer, right? So what do? You go buy the electronics at that place, and then you come to your shop that, let's say, which is 30 kilometers away, and you will mark up that same product and you will sell it, right? So that's the idea of arbitrage. You buy low in one market and sell high in another market. Okay, is this idea very clear with everyone? Speculation, hedging, and arbitrage.
Can
Yeah, Preeti, go ahead. You're breaking up. I can't hear you,
Sir,
Preeti.
sir, let me ask. You have written, sir, 95% in speculation and 5% in hedging. What is this, sir?
So what that means is 95% of the market participants, of the investors, are all speculators, and only 5% are hedgers. So this 95% and 5% are in terms of, hang on, I'll write it, in terms of investors. Okay, sure, Preeti, I'll explain. In terms of investors. Okay, all right. So let me explain hedging again. Okay, okay, I'm going to give you a silly example. Okay, but silly examples, actually help you guys understand. Now, how? So when you talk about a car and a bike, okay, okay, let's talk about a bike. Everybody knows a bicycle or a bike, motorcycle, whatever it is. How do you protect yourself from injury? Okay, insurance is one thing, but insurance is long term, right? Yes.
Helmet.
Yeah, so largely there's a helmet that is going to protect you, and maybe if you have the faster bikes, right, then you have a knee guard and a elbow guard, etc., knee pads and all of that, right? And those are always good to have as well, right? Now, when we talk about, yeah, Mithun, driving safely itself is a hedge in itself, but as we see, a lot of people don't drive safely. Okay. Um, so let's look at this now. The way you can protect yourself from injury when you're riding a bike is having a helmet, right? And it's so many times it's been proven that wearing a helmet will save your life, right? Now, my question to you is, it's a silly question. Will you wear a helmet if you don't have a head? Imagine you don't have a head, but the rest of your body exists. Would you put a helmet on if there is no head? Yeah, obviously not, right? Yeah. So that is the idea of hedging, is that if you have a head, you want to protect your head. Now, how are you going to protect your head? Use a helmet. Okay. Now, let's translate that into the financial markets, is that if you're an investor, and Preeti, imagine you have invested, let's say 10 lakh rupees in Infosys shares. Now, what are you worried about? That Infosys shares, let's say, loses its value to like 5 lakhs or goes down to even 1 lakh. Your investment goes down, right? Or the value of your investment goes down. So, how can you protect your investment? Is by hedging, right? So, you can enter into a derivative contract to protect yourself in case the price goes down. Okay, and we'll talk about those kind of examples in a bit. Okay, but is this all very clear with in terms of speculation, hedging, and arbitrage? Okay.
So we can say that, sorry to interrupt, we can say that the intraday trading is speculation in itself.
Yeah, intraday and all is all speculation. Even see, don't think about it that way. If you don't own the underlying asset, you're a speculator. Just keep it simple, right? Now, see, you can do like a 1 month or a 3 months futures contract, and if you don't own the underlying asset, you're still a speculator. So the idea is, do you own it or you don't own it? So if you own it, you're a hedger. If you don't own it, you're a speculator. Okay.
Okay, thank you, sir.
Hello. Hello.
Yeah, Nikhil.
Yeah. Can you tell me what you are saying? You have on it. Like I have purchased in the cash market. You are saying.
Sorry, I didn't understand.
You are saying if you have on it underlying asset, can you elaborate much on this?
No. So if you own,
Hello.
see, no, let me see. Let's say you bought 10,000 shares of Infosys,
Okay. In the
and
cash market, na?
yeah, in the cash market. So cash market,
Oh, okay. Okay.
yeah, yeah.
Okay.
Cash, guys,
Okay.
cash
Okay.
market in India. So
Yeah. Yeah.
most of an Indian term. So others might not be aware. So we use the term cash market for the equity market here in India. Okay. And if you guys remember, we talked about it as cash equities, right? So that's where the term also comes from. So we buy the shares in the cash market or the equity market, but we enter into a derivative contract, or we enter into the derivatives market to buy a derivative contract. Okay.
That's a different thing.
Yeah, that's a different place. Yes. Okay.
So can you tell me, like in the abroad, matlab, like in the US, what they say in the cash market, equity market?
They just say equity market.
They say equity market. Okay. Okay. Thank you.
Yeah. Okay. All right. Now the last.
I have a question. I
Yeah.
have a question. So when you say hedging,
Mhm.
it means that you are buying, you have shares in a particular company, and you're buying a protection against those shares if there are any fluctuations in the future.
Yes, exactly.
Kind of, right? Okay. And
Yes.
it's a contract where your shares are protected uh, for a time period, right? Kind of. Am I
Yeah. For a time
okay?
period against the price going down.
Okay, got it.
Okay. So, Saneen, good question. So, see, stop loss will not be considered as hedging. That's more of a trading, what do you call it? I would say strategy where you don't want to incur losses, but that is not a derivative. So, stop loss is more of what you would do when you're trading in the markets. So, stop loss, let's say, is let's say you bought something at 100, but you put a stop loss at 95. So, if the price goes down to 95, you're automatically thrown out of the contract. So that's not hedging. That's to protect yourself from losing your capital, yeah, or minimizing your loss. Okay. All right. So what is derivatives? Why is derivatives? And the last one is, where is derivatives traded? Okay, is that two places. One is what we call as ETD. Okay, exchange traded derivatives. Okay, and examples of exchange traded derivatives are futures and options. Okay, and then we have over the counter market, or the OTC market, and this is where forwards, swaps, structured products, options, etc. will get traded in the OTC market. Okay, so this is where derivatives are traded. So no, Nikhil, see, based on you purchase so let's understand this again, guys, is that hang on, let me, 1 second. So imagine that you have a 100 shares. Sorry, uh, hang on. Cannot draw this. So let's say you had 100 shares of Infosys. Okay. Now, so we have the 100 shares of Infosys. Okay, so I'm going to put this in a box. Okay. Now, this 100 shares of Infosys is the underlying asset. Okay, and a derivative, okay, for example, let's say a futures contract, right? Sorry, Well, you guys are getting the idea, right? Hang on, let me. Okay, so here's your underlying asset, okay? And what happens is that the derivative contract sits on top of the Infosys shares, okay? Now, if Infosys shares go up, what will happen to the derivative contract will also go up. If Infosys shares go down, what will happen to the derivative contract? It will also go down, okay? So rather, Nikhil, any relation between futures of Infosys and that too I purchased in cash market? See, the futures contract is taking its movement of price based on how the shares of Infosys is performing, okay? So guys, let's understand this. If Infosys share price is going down, equity is going down, so will the derivative contract, okay? If Infosys share price is going up, so will the derivative contract. It cannot be that share price is going down but the derivative contract is going up. That cannot exist, okay? Because a derivative does not have a mind of its own, okay? It's going to reflect exactly what's happening on the underlying asset, okay? Is this clear, Nikhil? Okay. Saurabh, does hedging play as a
Yes.
compensating role? Okay, compensating role if price goes. So, Saurabh, I wouldn't say it's compensates. Well, if you get it, if it's a perfect hedge, then you get compensated. Basically, you will not earn any losses on the trade. So, give me some time. We'll talk about some examples, and then that should hopefully clarify that.
So like you can maintain the average, like if you bought the higher price of the share, like ICICI, I bought a 370. If it comes to 320, so I will buy the more shares, so it becomes the average of the price also. That like also work as a hedging, or
No, 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 no. That is not hedging. That is
okay,
not.
that's a different thing. Okay.
That's in terms of investing. So you buying, you're averaging price, you average price down your investment. That is not hedging. See, guys, please
Okay, because
understand.
I am,
Hedging
yeah.
only happens in the derivative market. You buying at a lower price when you already own it. That's not hedging. You're just uh, average costing it down.
Okay.
Okay. So, Saurabh, give me a few minutes. We'll come to it and we'll talk about how you know. Well, it's not, if it's a perfect hedge, then you will be compensated for the loss, okay? But it's very hard to become get a perfect hedge in place, okay? But we can I'll talk about it and then I'll show you how you can reduce your losses, okay? So is this idea very clear about what is derivatives, why it's traded, and where it is traded? Now again, please understand that derivatives does not have a mind of its own. It's going to do what the underlying asset is doing. So if the underlying asset price is going up, same thing is going to happen to the derivative contract. If the underlying asset price is going down, so is the price of the derivative contract. Okay. All right. Quickly write this down and then we'll move on.
Can you please explain the last part again from the contract, derivative contract of Infosys?
Okay, so what I'm saying is that if you own 100 shares of Infosys, that's your underlying asset. So if the share price of Infosys goes up, and let's say you have entered into a derivative contract as well, right? So if the share price of Infosys goes up, so will the derivative contract. If Infosys share price comes down, so will the derivative contract. So the derivative, so, and look how we, the definition that we've used is that it's taking its price, right? So if the price goes up or down, so will the derivative contract, right? Is that clear?
Right. Then what's the need of derivative when it is based on the market? Like, are you getting my point? Like, it's parallel with the price of the current market rate, right?
Yeah, exactly.
Okay, if it goes down, the derivative will go down too, and if the market price goes up, the derivative will go up too, right?
Yes.
So, what is the need of the derivative then? Matlab, like,
Okay, now
Same question, sir, because it's like more or less the we are trading in the ordinary ones now. So
yeah.
why derivatives required at that point?
Okay. Okay, I'll answer that. See, originally when derivatives was created, like more than 100 years ago, it was created to protect the farmers and wholesalers from price fluctuations. Okay, see, back then, 100, 150 years ago, when we talk about derivative contracts, I mean, we talk about commodities. That was the market at that time, right? So as a farmer, and even if you look at it now, right, farmers are at the mercy of the environment and nature. So they're always worried that, what if by the time harvest comes down, the value of this particular commodity goes down in value, and they'll end up making losses. So that is why they created the derivative contract to protect farmers and wholesalers from these price fluctuations. That's why it was created. Now, when you talk about it in modern times, right, a lot of people don't want to become long-term investors. Okay, a lot of people just want to get into the market, make money, and get out. So that's why your derivative market exists as well, because you can enter into the market, make, and let's say you're a speculator, you can make X amount of money in maybe a day to a month or whatever it is, and you enter into those contracts, you make your money and you get out. That's it. But the idea when you're trading derivatives, right, is that you're not a long-term investor. You are coming in to make money and getting out. That's the idea. Is this clear? Yes. Okay. Good question. Okay. Finish writing and let me know when you're done, and we'll move on to the first example of a derivative contract. Okay. Everyone done? Yeah, Ritesh. So
Uh,
you carry forward your shares. You can carry forward the contract. So futures contract we talk about in a bit, but when we talk about futures, you can trade up to 3 months. Yes, sir. Had a question?
yeah. Does it sound like an insurance type? Like if the price has gone down,
Mm-hmm.
then what? Like hedging plays a role that in that case.
Yeah, exactly.
Like yeah.
Yeah, you're correct. It's like an insurance.
Okay.
Okay. Shall we continue? Okay, so let's look at your first derivative contract. And the first one we're going to talk about is forwards. Okay. Now, forwards is an OTC derivative contract where the price is agreed today for a future settlement date. Okay. Now, let's talk about this. Okay. Now, let's say I'm a seller, okay? Or I can even be, let's say, a client or an investment bank or whatever it is. And let's say you guys, okay, are, a buyer, okay? You're a buyer and you are a client, okay? Is this part clear? So remember what was the first word? Derivative is a contract, okay? So you and I are going to what? We're going to sit across from each other and we're going to negotiate a derivative contract, okay? So yeah, an agreement, okay? So I'm the seller or the investment bank and you are the client and the buyer, okay? Now let's say that I'm using you guys as you are CIBOP. Okay, you want to buy 10,000 shares of Apple at $112. I just checked the price. Yeah, it's $112 as of Friday closing. Okay, so you want to buy 10,000. Actually, 10,000 is less for you guys. Okay, 100,000 shares is good enough. So you guys want to buy 100,000 shares of Apple at $112. Okay. Now, where did we get this $112? It is
Market
yeah, market price or today's price. Or we'll use market price. It's the market price, spot price, today's price, etc. It all means the same thing. Okay. So you're going to buy 100,000 shares of Apple at $112. Let's say 10 months from now. Okay, what's 10 months from now? So September to September is
July,
here.
July,
Sorry,
July,
July.
July.
Okay, so what's today's date? 12th. Okay, so 12th July 2021 is what? Is the delivery date. Okay, is this idea clear with everyone? So again, I'm the investment bank, I'm the seller, you are the buyer. You want to buy 100,000 shares of Apple at $112 10 months from now. Okay, so 12th July 2021 is the delivery date. Now, in this case, you as a buyer, what are you expecting? What is your thought process by entering into this contract?
To increase the price after 10 months, like the market price would be different after 10 months.
Exactly, very good. So you are speculating the price is going up. Okay, now what about me as a seller? What am I thinking about? Maybe hedging. Okay, it could be I'm a hedger. Yeah, but largely I'm thinking the price is going to go down. Okay, so let's assume that I am a hedger. Okay, both are fine. Again, I'm expecting the price to go down. Okay, so guys, please understand one thing in the financial markets, right? Until unless you have two different points of view, then only the financial market can exist. So it cannot be that market will always be up, everybody thinks market is going to go up, or market is going to go down. It's exactly 50% think market is up, other 50% think market goes down. Okay, so then only you can enter into any, not only derivative contract but also in terms of buying a share. So when you're buying anything, right, you're expecting the price to go up. No, Saujanya, Apple shares are already listed in the secondary market, right? Apple, we're not talking about, we're not going to the company to buy the shares. The shares are already existing in the secondary market, and you and I have entered into the contract where you want to buy 100,000 shares of Apple 10 months from now. So it's not, it doesn't belong to Apple. So maybe I am currently
Okay.
owning the asset. So maybe I'm the owner right now of the shares of Apple.
Okay, makes sense. Yeah.
Yeah. Okay.
Rakshit,
Yeah.
is it like booking 10,000 shares right now and delivering it after 10 months, right?
Exactly.
The contract means the booking of 10,000 shares.
Yes, you book the 100,000 shares. So it's like placing an order saying that, hey, I want to buy this at today's price, but give me the delivery 10 months from now.
Okay, but the payment is made after 10 months or at the time of the contract
Very good question. It'll be
from
at
the buyer's side.
yeah, no. It'll be at the time of settlement on 12th July, not now.
Okay, thank you.
Sure. Okay. Now let's understand the next aspect to this. Okay, and let me add a few other things here. So,
One thing more, sir. On 12 12 July 2021,
mm,
if the price of the Apple one share goes down, like it's 100, so it
mm,
will be lost to the seller.
yeah,
So,
yeah, guys. So one thing, please understand, not everybody makes money in the financial market. 95% of people lose money in the market, and that's why your parents would keep telling you not to invest in the markets. Okay, but if you have no idea what you're doing, then you'll definitely lose money. Okay, but that's also important that
yeah.
you need to have a lot of people who don't know anything, so that they lose money and I make money. Yeah. Okay, so let's
If
look at
price go down, then the seller will be losing. If the price go up, then the buyer will be losing.
no, not yet. Give me 5 minutes or I'll explain it to you. Wait. Okay. All right. So now, 10 months from now, okay, 12th July, what can happen to price? It can either go up or go down, correct? Yes or no? And do we know for 100% it will go up or down? Do we know it? We don't know where it's going to be. Okay, that's the idea. Now let's take the first case of, let's say, Apple shares. Okay, let's say the Apple shares go up to, let's say, $145 on 12th July. Okay, so what does this mean? Okay, is that me, the seller, will transfer 100,000 shares of Apple to you at what price? Very good.
112.
Yes, at 1112. Okay, so I will transfer 100,000 shares of Apple to you at a price of $112. $112. Okay, now you, CIBOP, as the buyer, what will you do? You will buy at 112 and sell at what price?
145.
145.
140.
Yeah, and that's how the buyer is profitable. Now, how much would it be? So let's do a quick calculation. So 145 minus 1112 is 33. Oh, sorry. Hang on. Press the wrong button. Okay. So, all right, 145 minus 1112 into 100.
33,000.
Yeah, 33,000.
3,300,000. Yeah.
Okay. So you get a difference of $33 into 100,000 shares. Okay. So that equals three.
$3,300.
So hang on. You don't say $3,300. 1 second. 1, 2, 3, 4, 5. 3, 4, 5. Okay. So after 3 zeros, so in guys, with this, right, only in India, as far as I know, we use the lakh and crore system. Okay, but in the rest of the world, it's used in this manner. Okay, so after every 3 zeros you need to, so start from the right and move to the left. Okay, so after every 3 zeros you have to put a comma. Okay, so if we look at this, 100,000 into, hang on, yeah, so that is $3.3 million, not 33 million, Nikhil. It is $3.3 million profit to the buyer. Okay, okay, profit to the buyer. Now how much does the seller lose?
Same amount.
Very good. Yeah, how much does the seller lose? Same thing, $3,300,000 loss to the seller. Yep. So okay, yeah, that's a lot of profit if you're on the right side. But what if you're on the wrong side? That's a huge loss, right? So here's the thing: when you talk about derivatives, right? That's why it's super risky, is because you really need to understand the markets in order to trade derivatives. Yeah. Okay. Well, not necessarily, Saurabh. It really depends on a lot of things, right? Macroeconomics, microeconomics, politics, then how the company is performing, right? So, for example, Saurabh, then for example, Reliance, right? So, Reliance has zoomed up to 2,300 plus in the last few months. So, those who bought, made a lot of money. Like one of my good friends actually made quite a bit of money on that. Yeah. All right, now let's look at the second case of Apple shares. Now, what can be the second case? It goes down to, let's say, $90 on 12th July. Now, what will happen? I'm still going to transfer the shares to you at a price of 112. Okay, see, that's the idea of a forward contract, is that the price that we agreed today is the same price we're going to settle in the future. Okay, now in this case, okay, in this case, CIBOP as the buyer, okay, you guys would buy at 1112 and sell. Let's assume we'll just keep it as sell, just to keep it easy. Okay, and that's the loss the buyer incurs. Okay, now how do we figure out the loss? $90 minus 112 into $100,000. So 22 into $100,000 equals a loss of 2,200,000 loss to the buyer. And what does the seller make? Makes a profit of the same, of 2,200,000. Okay. So Saurabh, is it now clear? I think this is what you were getting to, right? This is what you were trying to understand. Okay.
Yeah, it makes sense. Yeah, good.
Yeah. Okay, cool. So, and guys, now let's look at this. Okay, now let's go back to these two words, speculation and hedging. Okay. Now, when you as a buyer, if you're speculating the price to go up and you got your speculation right, what is the end result of your speculation?
Profit.
Yeah, profit. But what
Arbitrage.
did you do? You hedged yourself against price risk. Yes or no? See, you got it right. See, you basically want to buy low and sell high, right? So what happened? You are thinking, hey, you know what? Apple share price is going to go up. Apple 12 is going. They're releasing Apple 12 shortly. They're releasing Apple Watch 6, etc., etc. And you are thinking, hey, you know what? Apple prices definitely go up, but not right now. Maybe because COVID is still happening, and the logistics is still not in place, etc. But definitely 10 months from now, the share price of Apple is definitely going to go up, right? So what did you end up doing? You were speculating, but the end result of your speculation is what? Hedging, right? You protected yourself from the price going up. Now, would you have liked to have bought 100,000 shares of Apple at 145 or at 112? Logically speaking, obviously, right? So are you guys getting this idea of speculation and hedging now, right? By entering into these contracts, you're speculating the price is going up or down, but if you get your speculation right, you end up hedging. That's the idea. Now, if you look at me, if I'm the seller, I'm expecting the price to go down. Now, if I enter into a forward contract with you, what's going to happen? And the price goes down, am I not hedging myself? Am I not protecting myself? So I'm selling you at 1112, whereas the market price is at 90. So I would lose out so much money. So I ended up protecting myself, right? So this is the idea, guys, that you guys have to be clear with, is that you're speculating and you're hedging. You're speculating and you're hedging. Okay. And that's how you make money.
Both,
You
both,
lose money as well.
both, both the buyer and seller are speculating in hedging, right? At the
Yes.
same time.
Yes. Okay, and tomorrow when we talk about options, right, I'll give you more examples of hedging. Okay, but for forward contract, is this very clear for you guys? Yes. Okay. Now, when you go to now, what some of you will do is you will what do you call it? You'll go to Google and you will Google example of forward contract, and they'll give you rice, wheat, and all of that. Okay. Now, when you go to an interview, if you talk about rice and wheat, right, that's not going to be very much appreciated even with me when I take your vivas. Okay. So you guys need to use a financial instrument, okay, like what we just talked about. So change Apple shares with Wipro or with Infosys, Amazon, Microsoft, Facebook, whatever it is, right? And you guys need to be able to explain it, okay? Need to be able to explain it. So, Saurabh, I won't get into another example right now because I mean the idea is the same, right? You just change Apple shares to, let's say, Microsoft shares, and the logic is the same thing, right? But rather, what I want you guys to do is, now that you've understood the concept, I want you guys as homework, right, write down or create an example of a forward contract, and I want you to do it 5 times. So pick 5 different stocks, any part of the world, and structure it the way I've shown you here. Okay, is this clear with everyone? So homework, first homework, 5 examples of a forward contract. Okay, so any stock anywhere in the world. Okay, you can even use gold, you can use crude oil. I don't want you guys to use commodities and all that because that's a very what do you call it, below average kind of example, right? So you guys are going to interviews at financial institutions. So if you talk in this manner, you are going to be taken a lot more seriously than somebody who talks in rice, wheat, and all that other stuff. Okay. All right. Quickly write this down. Have you guys written this down or not yet? Done. Okay. All right. I'll give you guys 2 minutes. Quickly write this down. No worries. You guys write it down.
Uh,
Yeah. Go ahead, Vinod.
can this contract can be cancelled at any point of time by the buyer,
No.
watching this price going down? Yeah.
Okay, so the answer is no. Now, the reason why I'm saying no is that these are financial contracts, okay, and these are entered in with big financial institutions, okay, and if you step out of the contract or cancel the contract, you are going to lose a lot of reputation in the market, and there will be legal issues as well, because see, it's an agreement, so these are all legally binding contracts, so you cannot just simply cancel these contracts.
Okay, but what does it make sense that at $112,
Hmm.
the buyer could have purchased the shares at that point of time in the month of September 2020 itself?
Hmm.
No matter how the price gonna get up or down, he's gonna pay $112 per share, right?
Hmm.
So is there any contract of lack of money at that point of time, or just a contract?
No, it's just a contract. See, you got to understand one thing.
Mm.
Can any of us tell the future? Can we
Sir, as
know?
Vinod is
Exactly.
asking, sir, as Vinod is asking a question, so can we book several forwards and future contracts at a particular point
Yeah,
of time,
you can do all of
according according to the market situation?
Yeah, you can see. You can enter into a forward contract with me. You can enter into with somebody else. It doesn't matter. As long as you meet your obligation, it's fine. As long as you meet your obligation, you can enter into as many forward contracts as you want.
But in the case of options, it is there now that we can put and call options and there.
Yeah,
We can implement or we cannot implement according to our own wish.
yeah. See, okay. Let me be clear here. In forward contracts, both parties are have an obligation. Okay, when you use the word obligation, you have no choice but to honor the contract. But in options, you have a choice. Okay, but in forwards, you don't have a choice. You have to honor the contract.
Okay, so in options, the some of the amount gets forfeited, right? So
Yeah. So we'll talk
if
about that
if the
tomorrow.
contract gets okay, okay, thank you.
Hang on, scrolling.
So, like the example you have taken, in this, the seller and buyer are at different points of references. Like one is a speculator and one is hedger.
Hmm.
So, if a particular buyer books the different forward contracts, then he can at a point of a time become a speculator as well as the hedger.
Yeah, with somebody else. Yeah, it can be. See, guys, whatever you see with the derivatives market, right? There's a lot of customization and flexibility. Okay, so whatever you think can happen plus more. Like things that you think that cannot happen can also happen in derivatives.
So I have a question. Okay. So initially, so both the buyer and the seller is a speculator, right?
Yes, correct.
Or only if they get the like the price movement right, then they are the hedgers.
Yeah, they end up hedging. That's the end result.
Yeah.
Let me know when you guys are done, and then we'll move on.
Sir, so
Do
hedge
we have to
funds.
go to the
Sorry.
Vatsal, you want to go ahead?
Okay. So hedge funds work in this similar principle, or it's something else?
They do this and other things as well. Hedge funds, they hedge funds, they also do a lot of other types of trading called high frequency trading, etc. So they do this as well because in hedge funds, because they take on high risk, right? They generally play a lot more in the derivative market than with let's say the equity market.
As this contract is held in OTC, over the counter
Mhm.
market, do we have over the counter market in India? As I have told, there is no over the counter market in India.
No, it's really, I mean, it's very, very tiny, and it's highly regulated by SEBI and RBI. So so technically, it's so small that it doesn't even exist. So yeah, you can say it doesn't really exist in the market in India. So we do have a forward markets commission and all of that, but there's really not much in the Indian markets for it. Okay, everyone.
And quick question:
Sure, sure.
is this just between big corporations, or as individuals? I can be a hedger and I can buy shares of another company. So it's not just between big shots, right? Even individuals can go
Yeah, so
into
the
this.
only difference here is that you and I cannot enter into a forward contract. We cannot do OTC derivatives. Okay, because OTC derivatives is restricted for retail traders. Okay, so if you want, you can, let's say, speculate on a share price of, let's say, TVS Motors or Bajaj Finance. That you can do, but that is on the exchange market, but not in the OTC. We're not allowed in the OTC market. Is that
Okay.
yeah? Okay.
This is so because there are small volumes in the retail market. That's why.
Sorry.
Why OTC derivative market shifting from the retail customers? It is so
Too
because like
risky, and your capital requirements have to be more than $1 billion to enter into the OTC derivative market.
yeah, you're right. Okay.
Okay, so are we clear with this? Are we clear with
Is there any time limit in this forward,
sorry,
like less than 1 year or?
Saurabh, say that again. I didn't hear you.
I meant to say that is there a time limit in forward, like less than 1 year we can trade in this?
Yeah. So good point is when we talk about forward contracts, they are traded up to 1 year only. Okay, so is that clear? It's up to 1 year.
Yeah, it's okay. It's less than 1 year. Okay.
No, don't say less than 1 year. Say up to 1 year.
Okay, like for a period of 1 month we can do that. For
So
a period of 12 months,
see,
365 days we
to
can
be
do,
clear
but more
here,
than 1 year it's not possible.
no, for forward contracts, it's not possible. You can
Okay, yeah,
enter into other derivative contracts where you can do for a longer period of time, but only for forward contracts you can do up to 1 year. Now, guys, let's understand one thing. If you enter into a forward contract for 1 month and all of that, that really doesn't make sense because share prices don't move that drastically in a month. Okay, so generally what I've seen is 3 month contract. So 3 months onwards is when they enter into the time period they enter into these contracts. Okay, but 1 month, 2 months, they generally don't. Okay, especially when the equity is the underlying asset. So Preeti, how does the buyer play the role of a hedger, right? So basically, they ended up buying Apple shares at 112. Now, if they did not enter into this derivative contract in July of next year, they would have to buy it at 145. So they ended up hedging themselves.
Okay, that means if they are making a contract, they have to fulfill it. Otherwise, they will make more losses than profit.
Exactly, yes. So Nikhil, last day, what do you mean by that? So on the last day, you honor the contract. Okay, so are we very clear with? Yeah, go ahead.
Yeah, like 365 days are there, right? In a year, like 360, like in the day, it is valid till the end day only.
Yeah, up to 1 year. All right. So are we very clear with forward contracts? So all of you guys, and you all have my email ID, at least 5 times. So when I say at least, so minimum 5, but if you can do more, please do so. Okay. So 5 times you guys create an example of a forward contract, use different stock prices, use different stocks, etc. Okay. Are we okay with this? Any questions? Are we crystal clear with this? Yes, Nikhil, we have to email. So one of the things that I learned a long time ago, right, is that one of the partners at Goldman Sachs, he used to tell us, okay, you must always trust the person to do their job, but you must always verify that they've done it. So I trust you that you're going to do it, but I'm still going to verify that you've done it or not. Yeah. So it's not that I don't trust you,
Sir,
but
so
I don't trust you like that. Yeah, Matsu.
sorry to interrupt, sir. So can you tell where does investment banks come into play between all this?
So the investment bank can act as a broker. So so if you come to me, Vatsal, I can find, let's say, Nikhil as your, counterparty to the trade, or I can only enter into the contract with you. So the role of the investment bank, right, is that of a broker. Now, see, please understand that you cannot go to a retail bank, like you cannot go to SBI and say, I want to enter into a forward contract. They're not going to understand anything that you said, okay? So you can only do these with investment banks.
Okay, sir.
All right. Okay, so shall we move on to the next one? Next derivative contract? And I think this is
Yes, sir. Yes, sir.
okay, and this is the longest I've explained forward contract. Okay, cool. All right, let's look at the next one, okay? So the next one that we're going to talk about is futures. Okay. Now let's understand one thing. We talk about futures. Okay. So futures is a standardized forward contract that is traded over the exchange. Okay. A futures contract is a standardized forward contract that is traded over the stock exchange. Okay, so the logic and all is more or less the same as a forward contract, but the main and there are a couple huge differences that we'll talk about. Okay, but it's traded over a stock exchange. Okay, so let's look at this. Okay, so futures are standardized forward contracts that are traded over the stock exchange. Now, what are some of the features? Okay, there is no counterparty default risk. Now, why there's no counterparty default risk? Because you have a clearing house. And an interesting thing about a futures contract and options that we'll talk about tomorrow is that trades can be executed without having the full cash requirements. Okay, what this means is that, see, if you let's look at point 2. Let's say company ABC shares, you want to buy let's say 200 shares, and they are at rupees 50. Okay, and this is an example of equity here. Okay, now if you wanted to buy 200 shares of ABC shares, how much money do you need in your account? Rupees 10,000. Yeah, so when you trade in the equity market, you need to have the money in your broker account. Okay, Now, if you have only, let's say, 1,000 rupees, okay, you can only buy 1,000 rupees worth. Okay, so this is the idea with the equity market. Now, in futures, okay, you don't need the full 10,000, and we call that as margins. And I don't want you guys to get confused about margins in terms of the equity market. That is a different thing, and what I'm going to teach you guys is a different thing. Okay, so trades can be executed without the full cash requirements. Why? Because you have to pay a margin. Now, both buyers and sellers of a futures contract have to pay and maintain margins. Okay, both buyers and sellers have to pay and maintain margins. Okay, and futures contracts are standardized. Now, what do we mean by standardized is that the amount of margin you have to pay to enter into the futures contract is the same for everyone. Okay, from a FII to a retail investor, everybody pays the same amount of margins. Okay, the maturity is the same, the lot
Sir,
size,
please
and
come.
lot size is
Sir,
quantity.
please come up regarding this margin.
Sorry.
Sir, I didn't understand the margin concept.
Yeah, 1 second, Piyush, I'll come to it. You just write, guys. First, see. Let me be clear with you guys. I'll go through the theory first, okay, and then I'll give you guys the examples, okay? Because if I just start directly with the example, right, you guys are not going to understand. Okay, so Piyush, don't worry, I'll get to it, okay? But just listen to what is being taught right now, okay?
Okay, sir.
All right. So when you talk about standardized, right? Margins are standardized, maturity is standardized, lot size. Okay. Now let's understand what is lot size here. So in the equity market, you can buy or sell one share. Okay. But in futures market, okay, we call that as a lot. Let's say we call that as a lot size. Okay. Now one lot will equal, let's say, 100 shares of company ABC. Okay, so this is the distinction between lot size and quantity. So it basically is quantity only, but in the futures market and options market, we call it as a lot size. And one lot will have 100 shares of company ABC. Okay, is this clear with everyone in terms of the features? No default risk. Trades can be executed without the full cash requirements. Both buyer and sellers have to pay and maintain margins, and these are standardized contracts. Is this clear with everyone? Okay, please write this down and then we'll talk more about margins. Everyone done? Okay. All right. Okay, so now let's talk more about margins, okay? And you guys really have to pay close attention to what I'm saying, okay? So when we enter into a futures contract, both buyer and seller have to pay margins, okay? Both buyer and seller have to pay margins, okay? Now, there are different like the names are different, but the logic is the same, okay? So let's look at this one by one. So the first one is what we call as an initial margin, okay? Now what's an initial margin is that it's the amount you pay to enter into a futures contract, okay? The next one is what we call a maintenance margin, and that's the minimum amount required to stay in the contract. Okay, initial is what you pay to enter. Now it is both the buyer and seller of the futures contract will have to pay an initial margin to enter into the futures contract, and they both have to maintain a minimum amount, okay, and that's known as a maintenance margin to stay in the futures contract. Okay, now due to price fluctuations, okay, on a daily basis, or not even daily, like on a second by second basis, there will be a mark to market calculation that happens, okay? Now what is essentially mark to market means is that based on the contract that you entered into and the price that you entered into, the price will either go up or go down, okay? And that's essentially, then what happens is that you're either going to be earning money or you'll be losing money. So that's the daily calculation of profit or loss, not both. Either you're going to make profit or you're going to make loss. So it's not that you can make both. Okay, in one contract you cannot do both. You're either going to make money or you're going to lose money, and that's known as mark to market, MTM for short. Okay, and the last one is what we call as a variable margin. Okay, now because of mark to market, your account can either increase or it can decrease. Now, in case your account decreases and goes below maintenance margin, then by using variable margin, you need to bring it up to initial margin. Okay, and this process is known as a margin call, and it is triggered by the clearinghouse, from the clearinghouse to the broker to you as the investor. Okay, so I know you guys, so we'll do an example of all of this, but did you understand the theory part? Initial margin is what you pay to enter. Maintenance is the minimum amount required to stay in the contract. Mark to market is daily calculation of profit or loss, sorry. And then in case your account balance goes below maintenance margin, a margin call will be triggered. And by using variable margin, you have to bring it to initial margin. Okay, so that's the idea with margins, and we will work out examples. Okay, so write down this theory and then we'll get to the example. So Bhargavi, mark to market is you're going to be calculating profit or loss on the contract that you've entered into. So don't worry, all of this, right, we'll go through it as an example. The futures margins are considered in terms of buyer and seller. Yeah, in the sense, both buyer and seller have to pay in order to enter into the futures contract, and they both have to pay the same amount.
So without paying the amount, they can do the business, right?
Sorry.
Without paying the whole amount, they can do the business. The buyer and the seller just giving the margin amounts
Yeah, only the
to the
margin
exchange
amount.
house.
Yeah, so you cannot be less than the margin account. It has to be the margin amount. Then only you can enter into a futures contract. Don't worry, we'll talk about an example. We'll do a couple of examples about this. Okay, everybody done writing? Okay, 2 minutes. Okay, go ahead. Okay. Okay, cool. I think majority are done. Okay, cool. So now let's understand more about margins. Okay. So I'll break this down step by step, okay? So before we can calculate the margin, right, we need to determine what the first thing we need to determine is what is the total contract value, okay, otherwise known as TCV, okay? Now have a look at this. So we need to figure out what is the total contract value, okay? So for example, if we say that, company ABC shares, one futures contract has a lot size of 50 shares. Okay. Now, if you want to buy, let's say, 10 contracts of company ABC shares, what's going to happen is 10 contracts into 50 lot size. So, what is the total number of shares that you're going to be buying? 500 shares of company ABC. Okay. Now, in order to determine the total contract value, okay, number of contracts into 10, number of contracts here is 10, lot size is 50, and the price, for example, is 305, okay? So the total contract value here is 1,52,500, okay? Is this part clear with everyone? So one futures contract of company ABC contained 50 shares. Now you want to buy 10 contracts. Okay, you want to buy 10 contracts of company ABC shares, futures. Okay, So 10 into 50 is total 500 shares is what you're getting access to. Okay. Now to determine the TCV, you're going to do number of contracts into lot size into price. Now, so that 305 is the current market price. Okay. And I think we discussed this last time. What's the difference between face value and market price?
So face
Face
value is the
value.
initial value on which the price on which the share was issued,
No.
and market price is the current price on which the share is trending according to the principles of demand and supply.
Okay. Any other answer?
Face value, the value which the organization issued their share,
Hmm.
and they will be giving back the return on that value only. And market price is the current market price. What is the market price of the share?
Okay, all right. So let me so all of it is correct. So let me give you guys another term which is I think a better term to use. So when we talk about face value, right? That's the legal value of the shares. Okay. Now, see, just now what was mentioned. So when companies calculate dividends, right? They calculate dividends based on face value and not market price. Okay. Now, let's say that if you bought, let's say, 10,000 shares of company ABC at 305 rupees, and let's say company ABC winds down, will you get paid at 305 rupees or will you get paid at face value?
Face value.
Yes, very good. It's at the face value, right? So that's why a better way to understand face value, it's the legal value. Okay. So it'll never be on the face value because that's from a company perspective. So we're talking about the current market price. So that 305 rupees is the current market price of company ABC. So so are we clear with this idea of total contract value? So, and we've not come to the margin part yet. But are you guys clear on how we figured out TCV? Yes, no?
Yes, sir.
Okay. All right. Now let's look at the next part of this. Okay. Now, and we're coming back to this concept of margins. Okay. Now, let's be honest. If you had 1.5 lakhs, couldn't you just go to the equity market and buy 500 shares? If you had 1.5, couldn't you just go to the equity market and buy shares?
Yes, sir.
Yeah, definitely, right? But now, do most of us have 1.5 lakhs lying around to play with?
No.
No.
No, no.
But would you like to have that kind of problem? I know I would. Like every month, 1.5, 2 lakhs to play in the market. And that's a good problem to have. Okay. So now, since you don't have 1.5 lakhs, now this is where the idea of margins come into picture. Now, it's the clearinghouse and the exchange will determine how much margin you have to pay to enter into a futures contract. Okay. Now, it is standardized, meaning that everybody in the market will have to pay the same percentage. Okay. Now, let's look at this is that it's a clearinghouse that is going to tell you how much initial margin you have to pay. Now, for example, the initial margin is 30%. Okay. Now, if it's 30%, what's going to happen is that you're going to calculate 30% on 1,52,500. So your initial margin that you're going to pay is 45,750. Okay. And then the maintenance margin is 15%. Okay. Now it's again 15% of 1.5 lakhs. Yeah. And the minimum your account balance can go to is 22,875. It cannot go below this. Now, if it goes below this, what will happen? Already answered. If it goes below 22,875, you need to bring it to Yeah, you need to bring it to initial margin by using variable margin. Okay, is this clear? Now, other part here is that you are only going to pay 45,750. You are not going to pay a sum of this. You're not going to pay, so you're not going to add both of these amount and give that. Rather, you are going to give 45,750 as your initial margin. Okay, is this clear with everyone?
So then where this maintenance
Yes, sir.
margin is being kept?
Yeah, Piyush, I'll come. What? I didn't understand.
So
No, no,
where this maintenance margin is being kept?
no. Part of your initial margin, see, you have to give 45,750, but part of that 45,750 is 22,875. See,
Okay.
it's like saying I'm giving you 100 rupees, but let's say in that 100 rupees, 40 rupees is somebody else, right? So that's the idea here, is that you're giving a total of 45,750, but then you are going to say, but what the exchange is saying is that your account balance cannot go below 22,875. Okay. Yes, Himanshu, go ahead.
So
Himanshu,
I have a
please.
question. So,
Yeah.
uh, if I have 22,000 in my account, how much time will I be given to meet 45,000?
Almost immediately. You don't have much time because the trade has gone against you. Brokers generally will give you a bit of leeway, but not too much. But ideally, you
So,
have
so
to
in,
bring it back within a couple of hours.
so in other words, 45,750 is the lock price, right? I mean, 22 is just you're saying it, but we still have to bring it up to 45, being that's
Exactly.
the main price
Yeah, not price. That's the amount.
amount.
Yeah,
Rakshit,
yeah.
if end of the day we end up in a profit,
Mm-hmm.
right? So can we move that amount with us, the profit amount? Can we extract that from the trade future contract?
No. Until you're in the futures contract, you cannot withdraw your profits. Only when you
So
exit.
it's like,
So let me finish. So
is 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 there any period defined in the future contract, like it's for 3 months, 4 months, 5, 8, and like
yeah.
that?
So when you enter into the contract, you have to determine the time period that you want to enter into. Generally, or all over the world, you can trade up to 3 months. So generally, September is what is being traded, but then you can also buy October and November, buy and sell even into that time period. But right now, the most volatility will happen in the month of September.
Okay,
Okay, and
thank
you
you.
cannot. So, and let me also clarify one point. Let's say you made a profit, you cannot withdraw that profit. Now let's say that you made 10,000 rupees profit and your account balance is 55,750. You cannot withdraw that 10,000 rupees if you're still in the contract. You have to exit the contract, then only you can withdraw the 10k. All right, is this clear with everyone? You
So
can
for
exit the
for for
contract.
three for 3 months continuously, our contract would be differentiated by the market price, and after 3 months we have to give the whole price, whatever is left, and then we can exit the contract, right? Like
No.
whatever the period is defined.
Yeah, see, you can enter into the futures contract anytime up to 3 months, but you can also exit anytime if you feel that your speculation is wrong. You don't have to stay in the contract for the entire period in exchange, but in futures, sorry, in forwards, you have to stay in the contract for the entire time period. But in exchange traded, you can exit and enter anytime.
So but future is also a kind of a
Okay.
forward contract, na?
Yeah, but in the futures world, you have a stock exchange and a clearing house mitigating your risk. right? So that is why you can do that. But in forward contract, you don't have those participants to manage your risk. So that's why you cannot do that.
Okay.
Yeah. Yes, Sajanya, 305 is the market price. Nikhil, we'll talk about rollover a little bit later. That is not as important as what we need to still discuss more about margins. Okay. So is this idea very clear with everyone? Okay. Again, this is an example. Okay. You switch out company ABC with Apple, Infosys, um, I don't know, Chinese company, Japanese company, Singapore. The logic is all the same all around the world. Okay. So are we clear with this? And are you guys done writing? Or do you need a minute? Yes, yes. In the secondary market. Yes, it's happening in the secondary market. Can you guys hear me?
Yes, yes, sir. Yeah, I can hear you, sir. So I want to ask one thing. So let's consider we entered into future contract at 45,750 on 13th of September, that is tomorrow. And
Mhm.
on 14th of September, this initial IM went up to 55,750. So can exit on Tuesday also,
Yeah, yeah.
or I have to stick for
That's what I'm saying, guys, is
okay.
that you can enter and exit these contracts anytime because you have the exchange
Hmm.
clearing house that will find a another person for the trade. Now, let's say that I've entered into a futures contract and you've entered into a futures contract, but you decide to exit. But what is the role of the
Yes, sir.
exchange clearing house is that they will find somebody else for me. Now, can I hold now if it's, let's say, a forward contract which is customized between you and I, is it going to be very easy or difficult to find somebody who will take that trade for you? It's going to be very difficult or almost not possible, right? So that is why you cannot exit a contract in the OTC market, but in futures market or an exchange market, you can exit because you have millions of people trading, okay, and you will always find a counterparty to the trade.
So
Okay,
the basic fundamental difference between forwards and future contract is this: one is traded over the counter market and another is traded over the exchange.
exactly.
Okay.
Okay.
And for future, you
Mhm.
can exit the contract whenever you want, but for forwards, that's not the case because it's over the counter, and it's
Exactly.
very difficult to get the person.
Yeah.
Okay.
Okay. Cool. Shall we move on?
So, sir, can you tell me that how will the brokerages earn in case of my investment here? It is 45,750. If after 1 month it falls to 35,750, then how will brokerages earn money?
Brokerage is calculated on basis points or like a percentage, okay, on the buy side and the sell side. See, your broker will make money on either the buy side. They'll make brokerage on both the buy side and the sell side, okay. And SEBI and all have given the like the minimum amount and maximum amount that a broker can charge, okay. And generally it's like 0.003%, okay. And that is something that you'll have to talk to your broker and negotiate, okay. But see, you got to understand, for broker, that is basically their livelihood, and that's how rent gets paid, etc. So that's why these commissions and all, you can negotiate with your broker if you have a good relationship with them.
Okay, okay, thank you, sir.
Yes, good point, Ritesh. Yes, you can actually. So that's what Nikhil was also asking. We'll come to this point. So let's say that in the current month you have taken a loss in your futures contract. You can carry forward that same contract to the next month. Okay, that's also possible. That's called rollover. We'll talk about that in a bit. Okay. Now let's focus on an example of a futures contract. Okay. All right. Now let's look at this. So if you're long futures, you're bullish and you are buying. Okay. So here you want to buy, okay, 10 contracts, 10 contracts of Hero Motor Corp. Okay. Everybody knows Hero, right? Now let's say, for example, the price is at 3,100. Okay. Lot size is 15. Initial margin is 35 and maintenance margin is 25. So what do we need to figure out first is the total contract value. So what's the formula for total contract value?
Number of contract into lot size into price.
Number of
Right.
contracts into lot price into price.
Okay. So number of contracts into lot size into price. So what's the number of contracts? 10. Lot size is 15 and price is 3,100. So what's the total contract value? Correct? 4,65,000. Now, can you guys figure out initial margin and tell me? Okay, everybody getting this? We're only doing basic multiplication here. It's not anything complex. Are we clear with this? Or do you want me to, do the calculation? And guys, some of
No,
you
no, clear, sir.
math, it's okay, because even I was never good at math and all of that, okay. So if you guys are not understanding, please feel free to ask, okay. So for TCV, you're just taking the number of contracts, which is 10, lot size is 15, and multiplying that by the current market price, which is 3,100, okay, and you get your total contract value. Now this 35% is the initial margin on the total contract value. So the total value is 1.6 lakhs is what you have to pay to enter into a futures contract. Okay. And 25% is the maintenance margin on TCV, and that's 1,16,250. Okay. 250 or 750?
250.
250.
250. Okay. Preetham might want to check your calculations again. Okay.
So,
So
sir, I have a question.
yeah,
So you're saying 10 contracts, lot size 15 means one contract has 15 shares, right?
exactly.
Okay. Yeah.
Okay, cool. Shall we move to the next part? Now look and listen carefully, okay? So On day one, when we entered into the futures contract, let's say we entered at 10 o'clock in the morning and the price was at 3,100. Okay. Now, at the end of the day, the price has gone to 3,150, right? The price has gone to 3,150. So, at the end of day one, did we make a profit or did we make a loss?
Profit.
Right? We all agree we made a profit. See, we bought at 3,100 and at the end of the day it's 3,150. So now how much profit did we make? Again, a small for this thing formula here. Number of contracts is 10, lot size is 15, and difference in prices 50. Yes. So if we multiply that out, how much do we get?
9,000.
7,500.
Sorry,
7,500.
7,500. So at the end of day one, you make a profit of 7,500. Okay. Now, what happens to your margin account? Does it still stay at 1,62,000 or does it decrease or does it increase?
Up by 7,500.
Exactly. So it goes up by 7,500. So how do we do that? Right. So 1,62,750
69,000.
plus 7,500. So how much does that come out to be?
One
One
lakh
lakh
71,250.
71,250.
1,71,250. Did everybody get this amount? 1,70,000. Okay.
1,70,250. 1,70,000.
Guys, everybody clear with these numbers? And there is no harm if you're not clear with it. I can always, show it to you guys. Are we sure you guys are clear? Okay, cool. All right. Now, what's happening on day two? So on day one, we moved from 100 to 150. Now, at the end of the day, on day two, what's the price? 3,175. So did we make a profit or did we make a loss? Profit.
Of course.
Okay, now here's an important question. How much? So 10 into 15 into what should
25.
be
25.
price?
25, sir.
25.
So
25.
because the earlier profit was booked on the previous day only.
Okay. All right. So, guys, one important thing when you talk about markets, right? You will never compare day one price with day three price or day two price. Okay. You will always compare it with yesterday's closing price. So, for example, if they say Reliance share price went up by 200 rupees, right? Now, is it 200 rupees from the time of the IPO or from yesterday's closing price?
Yesterday closing.
Yeah, so it's always from yesterday's closing price. So, okay, it's not going to be 50 plus 25 because see, we've already accounted for the 50. So that 7,500 rupees profit has already come to you. So that's why we won't account for it again. Okay, so we only have to account that 25 rupees difference from yesterday's close to today, yesterday's closing to today's closing. Okay, so what's the profit?
3,007.
Sorry, 3,007.
3,750.
Okay. So plus 3,750. Now what happens to your margin account?
Goes up by 3,750.
Yes. Tell me that. I don't have a calculator in front of me.
1,74,000.
Okay. 1,74,000. Are all of you clear with this? I mean, there's quite a few of you here. It's okay. I mean, if you're not understanding, please clarify. Even, I'm not the greatest math student, okay? But what we're doing here is pretty straightforward in terms of multiplication and subtraction and addition as well. Okay, are we good with this? Okay, now I'm going to guys give you 5 minutes exactly to figure out the rest of the day's prices. So you guys need to figure out 2,000, 1,950, all these things, and I'm giving you guys exactly 5 minutes. It's 4:31 right now, so I'll give you till 4:36. Go quickly. Don't worry about whether you got it right or wrong, and do not put the answer into the chat. You guys just finish and let me know when you're done, and then we'll start. But I'm giving you 5 minutes. Go. Okay, everyone done? It's okay. I mean, we'll do it together, but don't worry if you got it right or wrong. Yeah? Okay, now let's figure it out together. Okay, all right, and pay close attention, guys. Okay. Some of you might have got it, some of you might not. Okay, now when we talk about this day, day 3, the price is down by goes to 2000 rupees. So have you made a profit or a loss on this day?
Loss.
Loss. Okay, how much? So 10.
Loss.
I want you guys to do what do you call it?
175.
Do the like step by step until you guys get this correct. 175.
Yeah.
Should be 1175, right? 3000.
175.
1175. So how much would that be in terms of rupees?
176250.
176.
250.
250.
Okay. So now we all agree that this is a loss of 1,76,250. Okay. Now, what happens to your margin account?
2250. Negative amount.
2250 goes down.
Okay, so it is a negative 2,250. Now, can we still continue to the next day, or what happens now?
No, now we have to again bring back the margin to the initial level.
Okay, good. So, guys, please listen carefully here, right? What happened here is that our account balance from no, it was at 1,74,000. Okay, 1,74,000. Now, what happened? It came all the way down because what happened? The price moved against us, and now we are at a negative balance. Okay. Now, what does the rule state? That if your account balance goes below maintenance margin, what's going to happen? A margin call needs to be triggered, or it will be triggered. And what you have to do is you need to bring it up to 1,62,500. Right? Now, how much should we add? So again, we're going to go back into our bank account and we have to add the money back. So how much money should we add back?
$165.
I need exact numbers. 165.
1,65,000.
Okay.
1,65,000.
So 1,65,000 is what needs to be added back to the margin account to stay in the contract, or well, yeah, to stay in the contract, or to continue with the contract, whichever term. To continue with the contract. Okay, is this part clear with everyone? So now, even though we incurred this loss, right? What is our actual account margin balance going to be? 1,62,500. That is the
Not 500, sir. It's 750.
sorry, whatever. Okay, same thing. 750. So this is going to be the account balance. Is this clear with everyone? So again, I'm telling you guys, if your account balance goes below maintenance margin, a margin call will be triggered and you need to bring it to initial margin. Now, even if it goes to, let's say your account balance goes to 1,16,249 rupees, a margin call will be triggered and you need to bring it to initial margin. Okay, is this clear with everyone? Okay, now let's look at what happens on the next day, 1950. So here again, did we make a profit or did we make a loss? Okay, good. How much?
7,500.
7,500. So what will our account balance be?
1,55,250.
Now here again, do we do a margin call?
No.
Yes, no, we have differing answers. Okay, so Saurabh and Sunny, listen carefully, and Preeti as well. See, now is 1,55,000 above your maintenance margin. So as long as you're above 1,16,250, you're safe. So even if you took a loss of 7,500, you don't need to add any additional money. You can continue to stay in the contract. Now, in case your account balance goes below 1,16,000, then you have to add. But up till even, see, for example, even up till here, right? So even if you're, let's say, at rupees 1,16,251, you're still safe. You're still safe. Okay, you're still safe. Okay. All right, now what's happening? Okay, cool. Now profit or loss the next day? Profit, how much?
22,500.
22,500. Very good. And what will that come out to? 1,77,500. Right?
750. 750, sir.
750. Ah, okay. Oh yeah. Sorry. 750. No, Saurabh. Yeah, correct, Saurabh. So even if it goes down to 249, you have to go back to 750. Correct. All right. Now, the next day, 2,500, we make profit. How much?
60,000.
60,000. Okay. So how much would that be?
237. 750.
Okay. Next.
90,000.
Sorry, 9,000.
90,000. 90,000. 90,000, sir.
90,000. So what would this be?
327. 327. 750.
Okay. And the last one?
3,000. 330. 750.
Okay. So if you got 3,30,750, good job. All right. Now, if you didn't get it, it's okay. You need to go back and understand the concept. Okay. So let me again be clear. If you go anytime, so think of this as your safety net. Anytime you go below your safety net, margin call will get triggered and you need to bring it back to initial margin. Okay, is this clear with everyone?
Sir, I didn't understand that 2000 piece, that minus 2250. I didn't understand that 1,65000. How did that come back? That was confusing.
Okay, you mean this part here? Huh?
Yes, yeah, that part.
Okay, so see what happened here is that the price dropped from 3,175 to 2,000. So you lost. So the loss in price is 1,175. Oh, sorry, 1,175. And when you multiply that into the contract and loss size, you lost 1,76,250. So basically, this money will be debited from your broker account. Okay, and it will be transferred to the clearing house. Now, what ends up happening is if they deduct this amount from your account, then your account balance becomes negative 2,250, right? Now,
Uh,
go ahead.
So 1,750 minus your initial margin that was 1,62,750,
No,
right?
no,
So
no.
it,
Sorry, wait. It's your previous thing. See,
oh,
1,74,000. Hang on.
1,70,000.
Wait.
Sir, it's 75,000, right? When the price is 3,000.
I have no idea. Whatever you guys have told me, I've written that. So wait, we'll come to that. First, let me clarify the doubt.
Sure.
And guys, I have randomly made up this this thing. Okay, so see, your previous account balance is 1,74,000. Okay, now what has happened is you've incurred a loss of 1,76,250. So your account balance is now minus 2,250. Okay, now you need to bring your, if you want to stay in this contract, you need to bring it back to initial margin of 1,62,750. But since your account balance is already negative, how much more money you'll have to pay? 1,65,000, and you'll come back to 1,62,750.
Okay, yeah. Now it's clear. 1,65,000.
Yeah.
To kind of come into the market, you need to have 1,65,000.
Yes.
Taking that 1,250 away. Okay.
Yeah.
Okay.
What will happen, sir, if we don't add 1,65,000 here?
You'll be thrown out of the contract. The broker
Okay.
will throw you out of the contract.
So
No,
then for
that
I have a question in
throw me
this.
out of the contract. That's all right. What will be my net loss? Initial margin minus to added by 2,250.
No, see, since your account balance is already negative, you need to at least, not at least, you have to give back the 2,250 rupees because they've taken it from your broker. But that entire 1,62,750 is your money. Now that minus 2,250 they've taken from the broker, so you have to pay back the broker for that. Thanks.
Okay, thank you.
Okay. Yes, Sajane, continue with your question.
Yeah, so for the next one, that is 2,000 is clear. For 1,950,
Mm-hmm.
you incur a loss of 7,500, which again you get it by 10 into 15 into whatever was the loss, 7,500.
Yeah.
You get a figure there, right? What is that figure?
This figure or this figure?
Yeah, this 1,55,250.
Huh.
So how do you arrive at that? That one, just the next step.
Okay, so 1,62,750 minus 7,500.
1,65,000, right? From that you're subtracting
No,
7,500.
no. See, because your account balance went into negative, you have to give 1,65,000, right? Because your account
Okay.
balance is already negative, so your account balance has to come back to 1,62,750. That's your current account balance.
Okay.
And from
Okay.
that 7,500 is deducted.
Okay. Okay. So you're taking back your initial margin, that is 1,62,750,
Yeah.
and you're subtracting it with the loss, which was 7,500, which comes up to, okay, 1,55,250.
Yeah.
Okay.
Okay, sir, here I have one question
Sure.
with this. Okay, if we keep on adding this margin to
Mhm.
put up the margin, if we keep on adding the money, then at the end, the profit will not make any sense. Like if we keep on adding too much money into it. So
Yeah.
how does that work?
No, so here's the thing. You have to decide. See, let's put it this way. You entering into one futures contract, you cannot control the market. So you are speculating, what Hero Motorcorp price is going to go up, but if it's going down, it doesn't make sense to hold on to a losing position. So you should exit anytime you feel that you cannot handle any more of the losses. And you are right, it doesn't make sense to keep putting in the margin, because if you keep putting in the margin, you're going to lose more and more money, right? So the idea is, so it comes more from a trading perspective, is that you need to know when you want, like how much you want to risk and how much you want to lose and how much money you want to make. So if you have hit your target of saying that I want to make X amount of money, you should exit the contract. Essentially, that's what you have to do. So again, Nikhil, it goes back to the same point, is that whenever you need to, whenever you think you need to exit the contract, then you should do it. Nobody can tell you guys this. See, at the end of the
So
day,
there is no time limit.
in the sense, see, there is a time limit in terms of the contract expiring at the end of the month, but so when it expires at the end of the month, you cannot continue with this contract. You have to buy fresh contracts. Okay, but you need to decide when you think it is enough for you. Now, see, humans, we're very greedy. Obviously, we would like to make more and more and more money, but generally, the more greedy you get, the more money goes away from you. So, see, basically, it's a personal thing of when you think you should get out. If you've made your money, then you can get out. That's all. So you can stay all the way till 3020, or let's say at 2,37,000 you decide to exit, you can do that as well. See, all this, there is no, see, guys, in the financial markets like trading, right? It is unpredictable. Okay. Now, there's a lot of things out there that says you can predict the market. Now, honestly, if I could predict the market, I would be the richest person on the planet. Okay, and every day I can lose my entire money and I can make back that entire money every single day. I can become a trillionaire, right? But you cannot predict the market. It's random. Okay. All right. Any questions? So are we okay with this? Are we all clear with futures? Okay. So I will send you guys what do you call it? Some assignments on this so that it's you guys get some practice. Okay. Just give me 1 second. Let me.
I have a question from the previous money market class.
Go ahead.
Sir, I was going through the PPT and there it was written long or short tail. What does it signify, sir?
Okay, give me 1 second. Let me just take down the attendance, because the thing is, there's another class going to join and we might get kicked out. So just give me 1 second. Okay, let me also stop the recording here.